One of the biggest mistakes new investors make is waiting too long to start. The earlier you begin, the more time compound interest has to work its magic. Even small amounts invested in your 20s can grow exponentially by retirement. Waiting until your 30s or 40s means you'll need to invest much more to reach the same goal. Don't let fear or lack of knowledge hold you back. Start with what you can, even if it's just $20 a month. Time is your greatest ally in investing, so the best time to start is now. Many beginners believe they can predict market highs and lows to maximize gains. But even seasoned investors can't reliably time the market. Instead, focus on consistency by using strategies like dollar cost averaging. By investing a fixed amount regularly, you reduce the risk of buying at the wrong time. Remember, time in the market beats timing the market. Staying invested through market ups and downs is the key to long-term success. Putting all your money into one stock or asset class is risky. If that investment fails, you could lose everything. Diversification, spreading your money across different types of assets like stocks, bonds, and real estate reduces risk and improves long-term stability. For index funds or ETFs, which automatically diversify your portfolio. Well-diversified portfolio is your best defense against market volatility and poor performance in any single asset. Jumping into investing without a clear goal is like driving without a map. You might end up lost. Start by defining your financial goals. Are you saving for retirement, a home, or something else? Then, create a plan that fits your timeline and risk tolerance. A long-term goal like retirement may allow for more aggressive investments, while short-term goals require safer options. Having a plan keeps you focused and helps you avoid impulsive decisions. Many investors overlook how much fees can eat into their returns over time. High management fees on mutual funds or hidden costs in brokerage accounts can significantly reduce your profit. For low-cost index funds or ETFs with expense ratios below 0.2%, even a small percentage saved in fees can add up to thousands of dollars over decades. Always compare fees before choosing where to invest your money. Investing is emotional, especially when markets fluctuate. Fear during downturns and greed during booms can lead to bad decisions like panic selling or chasing overpriced stocks. Successful investors stay calm and stick to their strategy even during volatile times. Avoid making impulsive decisions based on headlines or market hype. Instead, focus on your long-term goals and remember that markets recover over time. Many beginners invest in stocks or assets they don't fully understand, often chasing trends or tips. This lack of knowledge can lead to poor decisions and unnecessary risks. Always research an investment before committing your money. Understand how it works, its risks, and its potential returns. If you're unsure, start with index funds or ETFs, which provide broad market exposure. Knowledge is power when it comes to investing is important, but so is having an emergency fund. Without one, you might be forced to sell investments at a loss during unexpected expenses like medical bills or car repairs. Aim to save 3 to 6 months worth of living expenses in a high-yield savings account before you invest heavily. An emergency fund provides financial security and keeps your investments intact during tough times. Dividends are a powerful tool for growing your portfolio, yet many investors overlook them. Instead of spending dividend payouts, reinvest them to buy more shares. Over time, this can compound your returns significantly. Many brokers offer automatic dividend reinvestment plans, DRIPs, to make this easy. Even small dividend payments can add up, boosting your long-term wealth without requiring additional contributions. It's tempting to go after investments promising high returns, like hot stocks or speculative assets. However, these often come with high risks and chasing them can lead to significant losses. Instead, focus on steady, reliable investments like index funds or diversified portfolios. These may not have sky-high returns, but they provide long-term growth and stability. Remember, slow and steady wins the race when it comes to building wealth. Over time, some investments will grow faster than others, throwing your portfolio out of balance. For example, if stocks outperform bonds, you might end up with more risk than you're comfortable with. Rebalancing means adjusting your investments to match your original asset allocation. This ensures you're not overly exposed to risk and helps maintain a strategy aligned with your financial goals. Aim to rebalance annually or whenever there's a significant market shift. Thinking you can consistently pick winning stocks is a common beginner mistake. Even professional fund managers struggle to outperform the market consistently. Instead of trying to pick individual stocks, consider low-cost index funds or ETFs that track the broader market. These options offer diversification and have historically outperformed most actively managed portfolios over the long term. Avoid overconfidence and stick to a proven strategy. Many investors focus solely on returns without considering inflation, which erodes purchasing power over time. For example, if inflation averages 3% annually, an investment earning 5% only provides a real return of 2%. To combat inflation, invest in assets that historically outpace it, such as stocks or real estate. Avoid keeping too much money in low-interest savings accounts, as they often fail to keep up with inflation. Short-term trading might seem exciting, but it's risky and often leads to higher taxes and fees. Long-term investing, on the other hand, benefits from compounding and lower capital gains taxes. Avoid the temptation to chase quick profits and focus on building a portfolio that grows steadily over time. Patience and consistency are far more effective than constant buying and selling. Taxes can significantly impact your investment returns, yet many beginners don't consider them. For example, selling investments within a year may result in higher short-term capital gains taxes. Use tax advantage accounts like IRAs, 401ks, or ISAs to minimize tax liability. Additionally, consider strategies like tax loss harvesting to offset gains. Being tax smart with your investments can save you thousands over the long term. Chasing the latest hot stock tip or investment trend is a recipe for disaster. By the time you hear about it, the best opportunity has likely passed. Many trendy investments are overhyped and carry significant risks. Instead, focus on building a diversified portfolio and sticking to your long-term strategy. Do your own research and avoid making decisions based on speculation or market noise. Staying disciplined pays off in the long run. Retirement accounts like IRAs, 401ks, or ISAs offer significant tax advantages that many investors overlook. Contributions to these accounts may be tax deductible or grow tax-free, depending on the account type. Additionally, many employers offer matching contributions for 401ks, which is essentially free money. By neglecting these accounts, you're leaving money on the table. Maximize these benefits to grow your wealth more efficiently. Investing isn't a set it and forget it process. Markets and personal circumstances change, so it's important to periodically review your portfolio, ensure your investments align with your goals and risk tolerance. For example, as you approach retirement, you may want to shift toward more conservative assets. Regular monitoring helps you stay on track and make necessary adjustments to optimize your strategy. Many beginners ignore small fees thinking they don't matter. However, even a 1% annual fee can significantly impact your long-term return. For example, over 30 years, a 1% fee on a $100,000 investment could cost you tens of thousands of dollars in lost growth. Always compare fees when choosing funds or brokers. Opt for low-cost index funds or ETFs to keep more of your money working for you. Investing is a marathon, not a sprint. Market downturns and slow growth periods can be discouraging, leading some to give up or pull their money out. However, history shows that markets recover and long-term investors are rewarded. Stay consistent, trust your strategy, and avoid reacting emotionally to short-term fluctuations. Remember, wealth building takes time, patience, and discipline. Keep your eyes on your financial goals, and don't let temporary setbacks derail your progress. Investing can feel overwhelming, especially when you're just starting. But avoiding these 20 common mistakes can set you on the path to success. Remember, the key to building wealth is staying consistent, disciplined, and informed. Start with small steps, like understanding your goals, diversifying your portfolio, and taking advantage of tax-advantaged accounts. Don't let fear or short-term setbacks discourage you. Investing is a long-term journey. Every dollar you invest today is a step closer to financial freedom tomorrow. If you found these tips helpful, give this video a thumbs up, share it with others, and subscribe for more investing advice. Your future self will thank you. Don't forget to leave a like and subscribe. Let's grow together.